Share. Okay, good morning, everyone. My name is Mirza Andhika, and today I will present my final assessment for Econometrics and Business. The title of my paper is The Relationship Between World Oil Prices and Gold Prices, an econometric analysis using ordinary least squares or OLS regression in short, with time series diagnostics. Now I want to present this topic a little differently. I am not only a student presenting a paper, but also an analyst explaining this directly to my lecturer. The main question is simple. Can oil prices help us understand the movement of gold prices? Because in financial markets perspective, oil and gold are not just commodities. Oil reflects energy demand, production cost, and inflation pressure. Gold, on the other hand, reflects safety, uncertainty, and long-term value preservation. So if you can understand the relationship between these two, it may help investors, policymakers, and market analysts make better decisions. So moving on to page number 2. Uh, this research used monthly time series data from January 2024 until year 26 in June. The dependent variable is world gold price and the independent variable is world oil price. The main method is ordinary least squares or OLS regression, but I do not stop at OLS only. Since this time series data, I also apply several diagnostic tests, including the ADF stationary test, Durbin-Watson autocorrelation test, Bush-Pagan heteroscedasticity test, Chart paranormality test, and Eagle-Granger cointegration test. So the things that I'm explaining here is not only a simple regression result. It is more complete econometric story. First, whether oil and gold move together. Second, whether the result is statistically reliable. And the third, whether the relationship is short-term noise or a long-run equilibrium. So the background of this study, of course, uh, it starts from the fact that oil and gold are two of the most important commodities in the world. Oil is connected to transportation, production, inflation, and economic economic activity. When the oil prices increase, production and transportation costs may also rise. This can create inflationary pressure. Gold, on the other hand, is often seen as a safe haven asset when investors feel uncertain about the economy, inflation, or geopolitical risk. They often move their money into gold. So, from a business and investment perspective, this relationship matters. The data will change. If oil prices rise, investor may ask, will gold price also rise? Can oil be used an early signal for gold movement, or are they moving together only because of external factors like US dollars, inflation, and also global other global uncertainty? So moving on to page 7. As you can see here, this is the monthly world oil and gold prices data from January 24 until June year 26. So basically, the data set contains uh, 30 monthly, sorry, yes, this. So the data says contains 30 monthly observation from January 24 to June. Here, oil price is measured in US dollars, as you can see, while gold price is measured in US dollars as well. Uh, it starts from around 2050 US dollars, and from the oil one, it starts from 2020. 2,250. Uh, and it reaches around 5,600 US dollars in January 26. Oil price, however, is more volatile and range bound. It moves between 64 and 105 US dollars per barrel, but it doesn't show the same strong upward trend as gold. So even before running the regression, we already have an important clue. Gold and oil may be related, but their relationship is probably not perfectly simple. This is why diagnosis testing becomes more important. Okay, and I present the descriptive statistics right here. So the model basically explains the average oil price is about 82.57 US dollars per barrel with a standard deviation of 10.94. This means oil prices fluctuate but do not extremely far from the average. Gold price, however, has much higher average, around 3,583.33 US dollars per troy ounce, with a standard deviation of 1,107.54. This shows that gold has much stronger movement during the sample period. Now, the correlation result it is also important. The Pearson correlation between oil price and gold price is 0.716. From an investor style interpretation, this is a strong positive signal. It means that when oil price moves upward, gold prices also tends to move upward as well. But the correlation alone is not enough. Correlation does not prove a relationship and it does not control statistical problems. This is why the next step is regression. This one. So from the regression that we estimate the OLS regression model, gold price equals minus 6,000 and 025.82 with oil price with a positive outcome, what 114.37. In simple terms, the results suggest that every $1 increase in oil price is associated with an increase about 114.37 US dollars in gold price. Now, of course, this does not mean oil is the only factor affecting gold, but it tells us that oil prices has a positive and statistically meaningful relationship with gold price in this model. Uh, if I explain this to the lecturer, I would say that oil price can act as one of the useful indicators for understanding gold price movement, especially in the long run commodity market context. Say here on page number 13, uh, with a moderate second ANOVA section shows that the model is statistically significant with an F statistic of 29.85 and a significance value below 0.001. It is right. Sorry. Okay. 0.001. So the first big finding is this. Oil prices has a positive and statistically significant relationship with gold price, but as econometrics student, myself, I can't stop here. Uh, it doesn't only sell the opportunity, a good uh, maybe analysis must also explain the risk. So on page 14, I summarize it. As you can see, this table is very important because it tells us that this is very low and indicates strong positive autocorrelation. In simple terms, the residuals are not fully independent. In time series data, this often happens because today's value is connected to previous months. The ADF test, however, shows that both oil price and gold price are non-stationary at level. So moving on to page 16. The ADF results show this more detail. Its statistic for difference oil price becomes minus 4.83, and for difference gold price it becomes minus 3.91. Both are significant. This means both variables are integrated of order 1 or I1. The key message is oil and gold are not stationary at level, but they become stationary after first difference. For investors or analysts, this means the raw price levels are trending. So we must be careful. We cannot rely on one simple regression unless we prove that the two variables have a valid long run relationship. This is why the next is co-integration. Co-integration. Okay, this one, Ingle-Granger tests. So I present the final diagnostic and co-integration output. The first one, the Busch-Pagan test, has a probability of 0.08. As you can see, 0.0. And the 0. Since this is above the 5% significance level, there is no strong evidence of heteroscedasticity. Second, the Jod paranormality test has probably 0.42 right here. And since since these residuals are stationary, we can conclude that oil and gold price are co-integrated. This is the strongest part of the study. It means that even though oil and gold prices are individually non-stationary, they still share a long equilibrium relationship. So the regression is not simply a random or spurious correlation. It can be interpreted as a long-run relationship between the two commodities. So what does this mean economically? The result supports the idea that oil and gold are connected through several channels. First, the inflation channel. Higher oil price can increase production and transportation costs, which may increase inflation pressure. In that situation becomes more attractive as an inflation hedge. Second, the US dollar channel. Both oil and gold priced globally in the US dollar, so movement in the dollar can affect both commodities. However, I also want to be realistic. Gold increased much more strongly than during this period. This means gold was likely affected by other factors as well, such as central bank demand or geopolitical situations, interest rate, and investors such. So, and moving on to page 2021. So the autocorrection and the use of one to conclude this, I'll wrap this up. First, oil has a positive and statistically significant relationship with gold price. Second, the estimated coefficient is 114.137 right here. Right, sorry. Okay. Uh, okay. Meaning that a single US dollar increase in oil price is associated with an increase of about 114.37 US dollars in gold price in the long run. Third, both oil and gold price are non-stationary at level and become stationary after first difference. Fourth, the Eagle-Grandy confers integration. Sorry. The Eagle-Granger test confirms co-integration, meaning that the relationship between the oil and gold is not merely spurious, but reflects a long-run equilibrium. Fifth, the model still has limitations, especially in strong autocorrelation and the use of only 30 monthly observations. So if we explain this, my final message would be oil price is not a perfect predictor of gold price, but it is a meaningful long-run signal and the relationship statistically significant, economically logical, and supported by co-integration evidence. However, for stronger forecasting, future research should use an error correction model, v VAR or VEZM, and include additional variables such as US dollar index, interest rate. Okay, that's basically much of all. Thank you very much for listening to my presentation. My name is Mirza Andhika Putra. Wassalamualaikum warahmatullahi wabarakatuh.